I think the first session was the most important session for us in terms of getting a global perspective. As I said earlier, we've got globally aligned, locally relevant. The locally relevant part is probably where we are now. So this is where we're talking about our own perspectives about IFRS 18. So now we get to deep dive a bit of IFRS 18. I'm getting some real experiences here in front. So we have Nick Reynolds joining us from Zespri. Laura Truman from EY, also NZASB member, and then we've got Andrea still. So there we go. I guess before we start our panel discussion, I am going to ask Laura and Nick just to introduce themselves briefly so that you know who they are. I just did, but there we go.
Thanks, Michelle. So, Lara Truman, I'm a partner here at EY. I run our IFRS desk, so technical accounting is kind of what I do. I've been on the NZASB for about, I think, 5 years now, and I love the interaction we have there and the ability to support and help us develop good standards. So, looking forward to chatting to you about IFRS 18.
Thank you. And hi, so I'm Nick Reynolds. So I worked for Zespri, but reasonably recent at Zespri. Recent being I started there on Monday.
So completely embedded in the role.
Yep, know everything. But before that I was with a company called Seeker, which is actually in the same value chain as Zespri, so I jumped to a different place in the same industry, but I was there for 7 years, group financial controller there. Before that, in the past life, I was an auditor for PwC in Hamilton. So I kind of get that perspective, and then also get the privilege of applying a standard, starting to the middle, or getting to the middle of one journey and beginning the next. So that's me. Sorry.
There we go. I guess before we start, the reason Nick is going to be great today. Everybody's going to be great, but Nick's going to be great because one of the first questions, and I'll get him to answer this later, but one of the first questions we asked him was, starting your IFRS 18 journey, if you had to restart now, knowing everything that you know now, what would you wish you had known? And he goes, Michelle, I'm about to embark this journey again. So it's really, really a privilege to have all of our panelists here today with us, and we're really looking forward to hearing their perspectives. I guess just to ensure that we are all on the same page and knowing what IFRS 18 entails, I'm just going to run through 3 slides. I'm going to take a few minutes. It's not going to take long, and then I'm going to go to the panel discussion. These 3 slides are all IFRS slides, so it's the copyrighted slides. I'll give credit. But I guess I just wanted to touch on the 3 pillars of IFRS 18, the main changes. And although Andreas have mentioned these before, I think this just gives context to a little bit more depth about what was said earlier. So the first category is the change to the P&L. So there we've got new subtotals, and you have to classify your information according to categories. So you have operating, investing, and financing categories that you need to that you have to classify your income and expenses accordingly. And then you go into income taxes and discontinued operations. Very important, or not important, but to know, you don't have to label it operating, investing, and financing. It's just merely your category, how you group it. Another piece that Andreas has mentioned was the fact that you have to bring in new subtotals. These subtotals are going to be operating profit and profit before financing and income tax. You still have your final P&L, profit or loss at the back end. All right, that doesn't go away. All right, the second thing I wanted to mention is your second pillar to the changes in IFRS 18. These are MPMs. So we're going to talk about MPMs. Just a reminder, we're using abbreviations everywhere. That's the non-GAAP measures that we spoke about earlier. That's when you have management-defined performance measures that management is publicly announcing about or communicating about management's views of the company's financial performance. This is an income statement type of change, so it's about MPMs linking to that income statement items. All right. Last pillar that we are talking about today is grouping of information. So IFRS 18 is bringing in some more information about aggregation and disaggregation of information. It allows you to think about what goes onto your primary statements and what's better suited in your note disclosures. Andreas did mention that other category that might be on your P&L. Do you question yourself about that? We're not saying that there is no room for other classification, but it is about really asking yourself and understanding what is captured in that other line item and how is that aggregated or disaggregated in your notes. How understandable is that information for users? Everything that we discuss in terms of IFRS 18 and also all accounting standards has a materiality overlay to that. Andreas has mentioned this before, but it's really important to remember that in all the conversations that you're having, etc. All right, so with that backdrop, my first question probably is to Andreas. I guess the question that we've had often is, IFRS 18 is also seen as a communication tool. So it's the way that you as an entity are depicting your story about what you've achieved for your profits, etc., for the year. So making sure that you as management are thinking about what the story is of the financial statements, but also how are you communicating that with your directors. My question to you is twofold. Andreas, what are you seeing internationally about how management is going about speaking to directors, about the involvement of directors in these conversations? And then secondly, how must entities start thinking about how they are communicating to users? Bearing in mind, users have seen your financial statements before, they are used to how it looks, and now it might change.
Great set of questions, Michelle. I think it's really a governance question in the end. It depends how good your governance model that you run the company on is. Because IFRS 18 doesn't really change what's happening in the company, but it puts an extended focus on how consistent are you in your communication by talking to the various groups. From a financial statements perspective, the financial statements are part of an annual report. And what we've depicted and users have depicted is a huge disconnect between the front half and the back half. Front half, everything is rosy, we are great, we're just a great bunch of people, and there's financial statements in the back. And if you get to those, sometimes you get a completely different story there. Is that another company or not? So these are obviously extreme cases. But the question is, where do you want to put the focus on? And part of our driver, I think, why we looked at these issues in here was really to rectify that impression and say, no, your financial statements really have to talk to your other narratives that exist. And the same thought logic, I would assume, should apply whether you're inside the financial statements or whether you're talking to other parties in your normal communication, be it internal or external. And so I would say that hopefully board of directors are involved because they are the ones that sign off the accounts in the end. So arguably, we had an interesting question yesterday to our terminology, and I thought it was a great question. You're defining this as management-defined performance measures. Do you mean that is the executive giving its view, or is it the board of directors that are giving their view of the company? And I thought that was a really interesting question, right? So arguably, there should not be two views, right? Hopefully, there should be one view, Highlander principle, right? As important as materiality. Highlander, there can only be one, right? One view, and that has to be consistently rolled out. Same thing with the investors, who are one notch further away from the company. The directors should have more insights into what's happening in the company. The investors are further removed. But for them, obviously, they are looking for pieces of discontinuity, for actually breakpoints where you say, well, that slide said that thing, but you just said something completely different. And why am I saying it in the end is a governance question? If you have CFO responsibility, the thing that I would fear most is actually that my name could appear on the front page of a big press article. if I'm saying something completely out of bounds that can't be traced back to systems on internal controls, I will be in big trouble. So it's the same thing about internally consistent information communicated in a consistent and coherent way that I think really drives this.
Perfect. There we go. My second question now is to Nick. I have preempted the question already, but I think the main question for me is just tell us a bit about your journey. How have you prepared for IFRS 18? Yes, where are you now? And what did you wish you had known when you started this journey?
Thank you. I suppose being in the situation I am, I'll start with the last question, was what did I wish I knew? Because like I mentioned, I got to probably the middle of the journey with Seeker, and that's where most of my talk about my journey will come from, and really am starting the journey again. And what I wish I knew when I first started out is that yes, standards pervasive, you get that, and yes, it impacts every company to a varying degree, some to a lot, some to a little, but it's actually not as daunting to start out as I thought it was when I was first starting the journey. Probably the beginning of my journey was sitting in a room like this, or watching videos and listening to podcasts and reading the big 4, big 6 firms' interpretation documents, and it was all quite overwhelming, lots of numbers, lots of changes, lots of, you might have to change your entire accounting system and get a whole new set of accounts and change everything. But what I found as I got over that discomfort and started to walk myself through the journey is actually, and this is my experience, but it wasn't as daunting as actually it sounded. We're setting up some new accounts and setting up some new processes, tracking information slightly differently, but most of the information is already there, right? It's not changing how you account for things. It's not a measurement standard. It is disclosure and communication and engaging with those stakeholders. And so I found that as I kind of got to the point where I was engaging with some stakeholders, mainly internally, but some externally as well, that actually I didn't need to convince them of I didn't have to teach them a whole new language. We're telling them it's the same numbers, it's the same information. Perhaps you find it in a slightly different part of the accounts. Maybe the MPM note suddenly becomes the most important note for some of those users. But yeah, it's once I got over that hurdle of, oh no, this is crazy, what do I do? Actually, I could slowly walk forward. And so my journey was having a look at the systems internally and locking myself into a dark room, as accountants like to do sometimes, and wrapping my head around what are we doing and what does it mean, and trying to map what the end product might look like, and then how do I bridge that gap. I also engaged with my auditors really, really early. So at Seeker, that was Grant Thornton, and it was great because I got another trip up to Auckland to sit in a room and have a chat with them and talk about kind of what they expected and what they were thinking and what they were seeing. And I found as a controller at Seeker that was probably one of the biggest things in my mind, because at the end of the day, they also have to agree with how I'm applying the standard. There was some communication along the way with senior management, and they kind of knew that this was coming in, and were asking people like myself, so what does it actually mean? What do we do? And my first question back to them was, well, do you want to change it internally, or is this just going to be an external? And once they started to make those decisions, you could start getting quite practical about what it actually meant. And that also included writing a technical paper up to the board and telling them that this is coming, we need to start thinking about it. All the way through to probably where I got to in the journey was we were releasing the paragraph in the financial statements that says this standard is coming into effect at this point. and starting to communicate to people like the board and the user of the accounts, hey, yep, it's coming. We're not going to sing to the heavens just yet, but flagging it. And that's where I got to with Seeker, and now that I'm with Zespri, I get to start that journey again and lock myself into another dark room and look at another chart of accounts and yeah. But I mean, everything I've spoken to internally there, they've already got board papers and they're already engaging with auditors, and in fact, one of them sent me some international examples of early adopters yesterday. So, you know, they're not starting from nothing either, and it's yeah, bit of fun.
Excellent. See, it's not too challenging. I guess my next question is to Laura. Laura, at IFRS desk, you're seeing a lot of questions coming through for IFRS 18 potentially. What are some key implications of the new requirements for practitioners that you want to highlight? Yes, I'll leave it there.
Thanks, Michelle. Look, as we've sort of heard today, it is a presentation and disclosure standard. You know, it's not like leases. We're not getting a whole new thing on our balance sheet that's changing everything that people need to try and explain. And I think it's going to impact different entities differently. There will be some of you out there that already do it pretty well and are reasonably aligned, so there may not be too much of an impact. There'll be some of you that, you know, you might have very complex operations, so you might have specific, you know, business activities, main business activities that you therefore have to change what you're doing. You might have significant information that you provide externally that's, you know, non-GAAP measures, and therefore you're going to have to do some work. So I think there's sort of two parts there, but I think there's then a third set of entities that sort of take this as an opportunity. It's a point in time that you get to stop and think about what you're doing. You know, I think one of the easy sells in this is, hey, you know, where does interest go? What should it be? What is it operating? Is it investing, financing? Where are you going to put your FX gains and losses? All those questions, the standard is really clear. This is what you should do. This is where it should go. Yeah, there's a bit of judgment, but mainly it's pretty obvious where a lot of the stuff will sit within that P&L. But what it does differently now is it provides you with guidance around what are you telling the market? What line items do you want on the face of your financial statements? How much information do you want to put there? What are you going to call these line items, and what stuff will go into each of those line items? How many subtotals do you want? You know, so it's the aggregation, disaggregation piece that I feel is really where you can spend a decent amount of time to try and get a better outcome. I don't think, and I think it's sometimes missed, you know, we try and fix what's in the wrong category, in the wrong bucket, and move on. But I think it's an opportunity. And what we do when we adopt 18 is it is going to be a policy choice around what you put, how much information, what do you think is something that gives you a structured outcome to your P&L, and then go from there. And I think what is really important is that you actually take the time to think about it and draft the papers and have a position. Talk within, you know, within the business, legal, comms, whoever it is. What is the real message we want to send here, and are we happy? And it may be that once you've done that work and you've thought about it, hey, what we've currently got is about right, or actually, no, we really think we want to actually drill down on this other line item that we have on our P&L and actually provide more useful information. So I sort of, you know, I could sit here and talk to you about the intricacies of where FX should go or shouldn't go and the difficulties of that. But I really sort of see this as more of an opportunity to be, how do we want to explain our results and what's important? And what I think is also relevant is these are policy choices that you are then stuck with going forward. So this is a point in time that you get to sort of start thinking about it and making sure that you have thought about it, and you can then step the auditors through it so that they become comfortable with the positions you've taken. And it's those judgment areas where you might call a line item other, and it makes sense because it is other. Or actually, no, this is something that's cost of sales and it should sit in cost of sales. It's those questions, and I think it's that piece that I really think, you guys should be working through to document and make sure you are happy with it. So I see that is the area that I think people should really spend time on and try and actually make some clear judgment calls and decisions, because that's what the standard is giving you the opportunity to do, to reset.
I guess we've said this many times in many of our podcasts and webinars, etc. But the earlier you start with IFRS 18, the better. The earlier you can start, the easier it is for you to have leeway in terms of timing if there is something that comes up that you need to work through, and not necessarily wait for that auditor to come in and then asking the question, because I think there's a lot of thinking that needs to happen beforehand. I guess the question that I have is to Laura as well, thinking about comparatives, just giving a little bit of a flavour of what these comparatives what people need to be aware of, that there is comparatives, etc.
Yeah, absolutely. And look, 1 January 27 is when the standard's applicable from. So your comparative period, if you're a December year end, you should have already been thinking about it. It is the information that you're gathering now for your comparative period that will need to be disclosed possibly differently. If you do interim financial statements, you will have to adopt that in your interim accounts, and what you put in those interim accounts must flow through to your full year end. There's some key transitional requirements there for interims. So you will be doing a retrospective application. You will need to disclose a reconciliation between what you previously had and what you now have, and what movements there are, and then explain those movements. So, there will be a lot of additional disclosures required there.
Perfect. In terms of engaging with your auditor, Nick, what was the type of discussions that you had around the table? Some practical discussions.
Yeah, sure. So I had a couple of conversations with auditors over the time, and the very first one was actually a really useful one, because they were also right at the beginning of how they were reading and interpreting and thinking about how it would be applied as well. And so rather than me sitting down at a table and saying this is how we're doing it, or the converse, the auditor sitting down and saying this is how you will do it, we got to kind of almost brainstorm and say, well, how do we think that this is going to be applied, and how do we think other players will apply it, and then specifically for our accounts, where do we think we need to spend the most time and the most effort and the most thought, and that was kind of right from the beginning, to be able to have that really collaborative conversation with the auditors. And then obviously as you go along time, I start to form a stronger view of where the biggest impacts actually are and what those outputs might look like, and then the auditors also form a similar view, and because we've engaged so early and had that brainstorm at the beginning, there was quite a lot of convergence. We were kind of, we're all going on the same journey, right? It's probably something maybe I didn't impress earlier, that the outcomes for different companies could be widely different. There could be people in the room who are going, this is going to completely change everything, and then there could be some people in the room are saying, actually, all I'm doing is putting a couple of subtotals in and thinking about disaggregation. But you don't know that until you start the journey, and everyone's journey at the beginning, at least, should be pretty similar. It's an accounting standard. So and hopefully engaging with auditors early means that you and the auditor are at least going on that same journey together.
Thanks.
No surprises. It's always useful to have a collaborative discussion with auditors and directors. I'm going to emphasize that piece. Please ensure that your directors are taking on the journey, because they are ultimately responsible for financial statements. Andreas, internationally, what are some challenges that we are hearing about? Do you want to share with us?
I would say, not surprisingly, the biggest challenges we hear is from those companies that have used a, shall I say, deliberate view on IAS 1, where you could question whether that actually was in the spirit of that standard. And I'm trying to be very diplomatic here. And I think the communication that the IASB had chosen when it developed the standard probably wasn't the most clever, because there was a time where we actually said the operating category is a residual category. Now, residual sounds like leftovers, right? No, it is actually, it's probably the most important category. And if you want one bottom line sentences is, you will find more things moving up into operating that previously you were probably stuffing somewhere else. The majority of those do have a negative sign in front of them. Yeah, and that obviously some companies didn't find particularly appealing, put it that way. So I think that probably puts some stress on the communications, but I would say this is not really, I would see this as a hygiene effect that the standard actually brought, because these discussions probably were happening already either within the company or between the company and its stakeholders. And it's really bringing a little bit of discipline back to the market and forming the same basis so that actually the results could be compared. I think what we are then seeing are some questions where both Lara and Nick said, actually, the standard provides you probably an answer in the majority of the questions, contrary to IAS 1, where there was more freedom, right? And everybody actually used that freedom in their particular way. Now, there is now a little discomfort because IFRS 18 is more prescriptive in some things, but it doesn't give you all the answers. So some of the things that are coming in actually had been discussed by the board, but we've decided not to actually make it part of the requirements because we believe it's not necessary for us to actually step in. One of the questions, for instance, is intercompany transactions or foreign currency transactions that are flowing through. I have sympathy with the practical question that come about, because if you're trying to design your systems, you need to have an answer to that question, and bloody hell, that damn standard doesn't give me the answer. So what do I do? And I would say the majority of the companies just want to do the right thing, right? So there is an honest approach, it's an honest question. But as I said, I mean, it boils down to, are you a fan of principles-based standards? If the answer is yes, then please don't refer to me, right? Use your brain. Build a judgment, right? Look what others are doing, and then form an opinion. I think both, given that we do have a regulator in the room, and the standard setter's view is, there needs to be a degree of tolerance for variances in the outcomes. That is the price to pay if you want principle-based standards. It's not one question, one answer. It could be one question and 5 answers. What we do want to control is that there is not a spectrum that is completely out of bounds, impairing the comparability of the results. That's really what we try to control, both the regulator and the standard setter. But it doesn't mean that everybody has to do it exactly the same way. Comparability is not uniformity. And I think if we bear that in mind, I think that will be good. So I would say not really big surprises. There's one, you could say, is that an oversight or not, or was that deliberate? So one question that we haven't spent an awful lot of time discussing is the income tax line. There are taxes on this planet that are not pure income taxes, but they have a certain connotation to that. And the question is, should they be going in that line? And if the answer is no, this will be an operating expense. I would say that question has existed already. There are IFRIC agenda decisions into that under the name of tonnage tax, which is one of those. Well, if you're a shipping company and tonnage tax applies, there had been a custom to actually put these tonnage taxes in the income tax line. And the Interpretations Committee said, no. And that was it. To be honest, the majority of the companies just ignored that and continued. So it doesn't surprise me that the same question now comes back in IFRS 18, now that we put a bit more stress on the different categories. But there is one interesting factor that is now being discussed, and that is a particular type of, shall we say, levy, not to use the word tax, that is being charged on companies and individuals in Muslim countries. They don't have income tax per se, but they do have something that you pay quasi-voluntary to the community. The net effect of that is not that distant and different to income taxes. And if you look into the Pillar 2 regime that the OECD had developed, they actually make a reference to that particular kind of payment, which is called zakat. So when we put out the standard, we didn't hear much from the Muslim countries, but we wanted to help application. So we said, should we be actually putting a question to our friends at the Interpretations Committee ourselves to just make sure that actually that thing is being picked up? Because we believe that zakat wasn't really going into the income statement line, or shouldn't be going into that income line, because it doesn't meet the strict definition of an income tax as per IAS 12, and IAS 12 was not changed. So that should go up into operating taxes. Boy, that got us friends, right? So people got really agitated, and now it's almost like the IASB versus the Muslim world, right? There had been times 15 years ago where we had a board member, an American, who was really outspoken, thought he would just throw in a funny remark in a discussion in a similar context and just said, well, if you don't like our results, you better change your faith. You could anticipate the shitstorm that happened. Yeah. So don't want to go through that again. So we put it in front of the Interpretations Committee, and the Interpretations Committee did a very smart thing. They analyzed the structure of IFRS 18 and said, we believe that the standard is pretty clear that this doesn't constitute an income tax. IFRS 18 didn't change. IAS 12 is still the same standard. And if you go through the characteristics, not quite there. But they then said, is that actually a sensible outcome? Is that an answer that does make sense? And a majority of the committee members said, probably not. Now, there's nothing that the Interpretations Committee can do because they don't have the mandate to change the standard. That can only be done by the board. So what they did is they referred the issue back up to the board and said, we were asked that question. The answer we think is clear. The standard gives you an answer, but we have questions as to whether that is the most sensible answer. So we urge you to look into this and potentially have a narrow standard setting project on that. That lets me shiver because I wouldn't know how to do the standard setting in that. You could do it in a very quick fix and you could say income and other taxes, but that would probably just open the floodgate and you see a whole lot actually being reclassified out of operating and say, thank you very much, IASB. You've just boosted my earnings. So where to draw the line, that will be difficult, yeah? But that was probably the one-off. The other thing I would say was the noise that was to be expected.
Perfect. I guess now it's over to you to ask if there's any questions for our panelists this morning. Yes, Carolyn.
Thanks. Thank you, all three of you. I just wondered if Nick, I don't know if you're have been at this stage in your journey, but Lara talked about comparatives, and I wondered whether with Seeker you did get to thinking about the comparatives and how much that either sped up the project or became a headache that kept you awake at night Yeah, because there could well be a lot of companies in the room who are at that point.
Thanks, Carla.
Yeah, thank you. Yes, well, I knew comparatives were being impacted, so that really was the kind of impetus on me, starting out of the blocks when I did, and trying to get in early because I knew that we have to do comparatives, so I knew that Seeka's a December year end, so from 1st of January this year, all of the information that's getting captured now, while they've got another year of applying the old standard, will have to be remapped into the new standard. And so that was a really real consideration and almost the deadline in my mind of, well, all this data needs to be captured. We set a budget in, before December, so if we need to start changing systems and trial balances and everything, which all the webinars were telling me we're going to have to do, that means, well, strongly suggested that it may be an impact. That was what was making me jump and say, all right, well, that means I don't have 2 years before I need to start thinking about it. I have 2 months, or I have a short amount of time, and it was reassuring for me when I got to the point of my journey where I realised, okay, yes, they are impacted, and yes, this is a thing I need to consider, and all of this data getting captured will be captured, but I don't need to make foundational changes to our ARP. I don't need to set up a whole new suite of accounts. And we were able to do that with a reasonably light touch, and didn't get to the stage of my journey where I started doing pro forma accounts, because probably need a few more months of data to be able to do that. But yeah, it was a consideration, and it was something that made it quite real. And I mean, looming is the wrong word to use, but looming.
Jaco. He's not part of the panel, although he sits close by.
Question for Nick as well. I'm Jaco. I'm from the FMA, so no regulated question. But what are you going to do to kind of inform your investors? Because I think that will be quite a daunting task. They will get a new set of P&L, and how are you going to kind of inform them appropriately about the changes?
Yeah, good question. Thank you. Yeah. So the investors and kind of, I guess, the user base of the accounts is really wide ranging. I know for Seeka there's a small number of kind of institutional investments who they're almost the easier ones to bring along the journey. They kind of understand that things change and these things happen, and they kind of understand that it was this number, now it's this number, and where to look. And maybe in a slight tangent, it really brings some importance to the NPM note, and I might have said earlier that that may become the most important note in the accounts to some of these investors, because they get to look at that and look at management's or governance's idea of what profitability is, and how they manage their accounts, and also if that's what they were looking at for the last X number of years, then it also provides them consistency over the period they're analysing. But for a lot of the other investors, smaller mum and dad investors, growers, which was a large investor base for people like Seeka, it's just really about communicating with them, and we hadn't quite got to that stage yet, because I think we were taking the same, I think you mentioned it earlier, not starting too early with the comms. There's a risk if we told them now that this thing is going to change in 2 years' time, they'll forget. Or if we tell them now and tell them every five weeks, it'll turn into nothing. So there is a plan, or was a plan, to start saying in some of these regular comms, things are changing. If you want to look at what was EBITDA for us, it'll be here. Otherwise, the dividend note stays the same.
There we go.
Hi, Lara. Excuse me, probably a question for you. In the current world, listed issuers provide their audited accounts, and they often provide a pro forma or underlying different set of numbers. And if I take, for example, say restructuring, one-off restructuring costs that they take below the operating profit line, in the past that hasn't been an audited number. As an investor, I've just sort of got a trust management team that those expenses won't repeat. How does this change your world as an auditor? So you'll now be auditing and sort of getting yourself comfortable that is a genuine one-off, and does that change the audit cost? Can you just take me through that process?
Firstly, I'm not an auditor. I just work for an audit firm, but I work very closely with our auditors. But look, I think you're right. Putting the MPM information into the accounts is clearly we now need to audit it. We're going to have to think about it. And I almost come back to what I was trying to say earlier. You're going to need a policy around what you believe is your underlying or your except for items. What do you want to have in there? Do you have a consistent approach that you apply every year around, hey, every year redundancies will not be in our MPM number. Every year impairments are going to get pulled out, restructuring will get pulled out. You need to ensure that you have a set, clear policy. It might be actually material items. Anything over $10 million will be considered an underlying amount that you want to, exclude. So I think it's about ensuring you have a set policy around what you want to do and what you want to keep in and keep out. And if you stick to that, I suspect the auditors will be quite comfortable because you are consistent in what you're doing, and you as well as explaining it. So that it's clear. Redundancies will always be excluded, and I think that's the key piece. I guess my key message really is that it's important to make sure that you are clear with what you will and won't put in, and why, I suppose.
Can I?
Yes, go.
Yeah. So that is an interesting question, and we have had quite some auditor pushback on that in the international world. And why? Because they said we now actually don't just have to check that number. That's the easy part. But there is probably a market expectation that this number actually is truthfully reflecting as to what management is saying it is. And there seems to be different expectation as to what does an audit of an MPM really entail. And there is no uniform view. If you just take the big four, two of them are saying no, we are being asked to just assure that this number is actually reflecting what management is using, to Lara's point, right? If you do have a policy, that's almost like going to the eye doctor and saying, can you see clearly? Of course I can, tick. That's different from do a substance check. Is that really reflecting what management purports it is reflecting? That's a different ballgame. Now, if I look into our standard, there's nothing that asks people to do so. And if you go to the International Audit Standards Board, they would equally say that's not really the requirement. So there are different views as to what is market expectation. And I think that's the bit that probably users and auditors need to really have a conversation about. What do you associate with those numbers? Treat them what they are. If management says we are using these numbers, you should be interrogating them. Do you have a policy? Do I see changes being made year by year? Are they opportunistically being treated? Then I would cast out, actually, is that really a management performance number? Or is that something to just massage your earnings line? All right? But if this is really a constant, I think it probably gives you some faith in dealing with that.
There we go. While I'm moving this side of the room, any other questions? Let me know, flag your hand.
My question's for Nick. Do you recall when you were at Seeker what sort of the biggest headache was, or what the biggest sort of practical implication when you were doing the, in terms of the P&L and the cash flow?
I'll walk slowly, you can think about it. Consolidate, there we go.
Trying to remember what gave me the most headaches. I suppose it's a difficult question to answer because kind of nothing really gave me a headache per se, but there were parts that maybe provided the biggest differences. So things like the cash flow, which we haven't talked about much, but the cash flow gets impacted as well. And actually, for Seeker, that was quite a big dollar value. And so while that's not a headache, that is a thing to recognise that those treatments are now prescribed, will be prescribed, and if a company has got interest expense or lease interest or something up in operating cash flow, well, that number might be quite a big number, and falling now into financing, it could be quite a big change to something like operating cash flow, which a lot of users do look at in some cases. And so while I say it's not a headache because it's prescribed, there's not a lot I can interpret there. There's nothing really to keep me awake at night. It's a big number. It's a big change. I suppose one of the other things that made me think about whether I was going to get a headache is less about the numbers and more about some of the decisions internally, and how maybe a management account changes. If a management account changes, and if it does change, that's a whole different project, and maybe that does change our reporting. And if it doesn't change, well then, how do we bridge that gap between your monthly management accounts versus an annual or an interim set of accounts, and kind of having those discussions with management and at the board level in some cases about do we want to change, and what might that look like, and if we don't, what does that look like? That was something that I knew was going to be not a quick conversation. I hadn't yet got to the stage where I was having a headache about how to change or apply those things, but yeah, I knew that was going to be a big thing to get across the line, whichever side of the fence the company fell on.
Smart. I guess the only other thing I'd add to that would possibly be FX. If it's a significant item for you, often clients just stick it straight in one line, full stop, move on. That's where a lot of thinking is going to be needed if you have it as a material item, and I think that's where you could see some changes. So.
Yeah, that's a good point, because like I said, we didn't make too many changes to, say, a chart of accounts. That was an account that was set up, FX on financing, which was originally grouped in with some other FX. Well, now the underlying transaction isn't operational, it's financing. So that was a change.
Got a few more questions this side. If I missed that side, I'll have a look now. But I've got two this side. I'm going to go yes, Susan.
Thank you. Appreciate you haven't been doing a hard sell here, Lara, but with every finance community running lean and nimble at the moment, I'm actually interested in hearing how you're helping clients, non-audit clients, in a consulting and paid capacity. How can you help? What's available?
Ooh. I'm running.
I could probably pass this one to David, but I won't. Look, absolutely. The issue with it is it's all new, right? As Nick said, we are starting this journey now. We have a couple of audit clients that are going through this. We have a big client in Australia that's gone through it. So we have spent the time, and I think it's about, I tend to be harping on about this, but I think it's about building those policies. It's how we can support you to draft what a policy might look like, how you then bring that to the board, and I think actually get buy-in from the whole of the company. I think that's where we can help support in terms of, I'm sure there'll be people at EY that can do systems changes and do that sort of stuff, but I suspect I'm coming from an accounting perspective, we would be able to draft accounts, draft papers, and identify issues, and obviously explain these to your auditors. Right, that's where I can imagine a lot of our support could be.
Yep, I'm coming. I'm going to take 2 questions, this one and David, and then we'll go back to the panelists.
Thanks. I actually have got a question for Nick. So, have you experienced any, reverse impact on your financial ratio after you have done that changes? And hopefully, positive, but do you have any negative ratio impact and how you navigate that?
Yeah, good question, and kind of testing my memory a little bit. No, I don't think there were negative ratio impacts, but it's because it kind of changes, and then the way you look at it changes. I don't think, correct me if I'm wrong, the intent of the standard was to drive a harsher ratio, and while ratios may and do and did change, cash flow one being the kind of starkest one, because if someone's doing any sort of ratio on an operating cash flow number, for Seeker at least, because that number changes quite a bit, then that ratio would change quite a bit. But I don't. But if we're bringing our banks along on a journey, or our investors and kind of analysts along on the journey, then hopefully we can get across the fact that these ratios are changing, but the business isn't changing, and the activities aren't changing, and the way that money is being made and profit is being driven isn't changing. So perhaps we lose a 10-year average, or perhaps we go back and present an extra 10 years of information if we can. But I don't think the intent was to drive a tighter ratio, and if we can communicate the changes well, then surely a bank and an analyst and an interpreter will understand the changes, right? Test my memory, I can't profess to have had those conversations with banks or analysts, but I think you know what I mean.
Yeah, I guess the conversation is still you need consideration on any loan covenants and what that might look like, and also making sure that your users, being your bank in that instance, understands if there's going to be an underlying change, but also understand if it's different and how that loan covenants might need to change for whatever reason that might be.
MPMs, management performance measures. I'm wondering if any of you feel there'll be an increased appetite or desire for companies to include more than just the performance measures from management in the audited financial statements. So, for example, in New Zealand, net adjusted debt is quite common. The FMA obviously has guidance out on non-GAAP measures that companies need to comply with. I think from an investor's perspective, it gets quite messy when you have certain management non-GAAP measures in one section, and then in your investor relations section, you've got other measures in there. So I was just wondering to see whether you think that, even though not an explicit requirement of 18, whether we'll end up voluntarily getting more non-GAAP disclosures in the financial statements. And Nick, if you had any discussion with your investor relation team around that.
Before I give it to Nick, I think this may be an Andreas question, because I know about the cash flow statement work, so maybe you can give some clarity about international thinking on that.
So as you say, I mean, there are probably more MPMs or KPIs that management uses. Not necessarily any KPI has to go into the financials, to be clear. But I think also to Lara's and Nick's points, I think 18 gives you a reflection point. And some have misunderstood our objective. Get me as many MPMs as is possible. Is that there is no requirement. If you don't have MPMs, well, that is one requirement less that you need to follow, right? So there's actually an incentive. And several companies on the continent in Europe actually have started thinking, who previously communicated non-GAAP measures to their investors, do we really want to continue that? Or do we now think actually having a common language with operating profit actually is beneficial. Let's put more stress on that, and let's not do our own thinking, right? So it could go both ways, I would say. And as I said, we believe that yes, there are MPMs that lend themselves to the same logic. So we are saying the entire requirements around providing a reconciliation actually was taken from the regulatory space, from what existed outside of the financials. So we just looked at, okay, what's available, and what the regulators had was pretty consistent around the globe. So we said that probably gives us a good basis, and let's use the same mechanism in the financial statements. So as I said, in the statement of cash flows, we will provide the same logic. I wonder whether we will do something similar for the balance sheet. And there are obviously other KPIs that have no hook into any of the financials, that they probably will just continue to be there. So if, for instance, if you're a property developer and having some KPIs around square meters or whatever, where do you want to tie it to? There's no hook in the financial statements, so therefore you can't use that in the same way.
Yeah, I mean, I suppose I don't have much to add on top of that, but I hadn't had a conversation with internally on it yet, but only, or not formally at least, because I mean informally I think we're already thinking about things that we talk about and KPIs that the business would measure itself on and portray out to growers, but if the question is, do we think there'll be more MPMs? For some companies, sure, I'm sure they'd like to disclose more and put more voluntary stuff out there to help their users if they think it helps their users. But may find the opposite, and if anyone's regulating Seeker out there, please don't quote me on it, but it may end up that the language that gets used externally or wider, like you said, changes, and to try to minimise MPMs, if you've got a measure that you don't have to put in the financial statements, don't have to get audited, I'm not sure too many companies would be keen to put themselves under more scrutiny than is required, especially if they don't feel like it's adding value or assisting their users.
I think that's where it comes into the conversation with the IR team. I know some companies, like net debt is a huge one. So not talking about adding more, but say companies is actually our main non-GAAP measure is actually a balance sheet measure, not a P&L measure.
Yeah.
It gives the IR team that I've spoken to would say it gives our investors confidence in this number. Why is it on a different footing to a performance-based measure?
Yeah.
That's all.
Yeah, sure, and I guess I accept that, because if a company does believe that net debt is what their users need, or if someone wants to do something with, say, IFRS 16 and either back it out to the old world or make it more important in the new world, then if they feel like that their users will get benefit from that, and the benefit of being audited and benefit of being in the place of semi-prominence, because you're on the face, you're on in a note. Yeah, for sure. But if it doesn't, I don't know. I wouldn't.
I think yes. There we go. Nina.
Nick commented in the beginning, but this may be just a broader question for any of the panelists. I feel like there's a misconception with accounting standards that you can just lock your financial controller or your technical accountant in a room and bam, they'll just churn out the new set of financials. Could you comment how, in particular for IFRS 18, the importance and the role that some of the other areas of the business, FP&A, Treasury, Tax, IT, all that should really be playing, and how that's important to kind of set up as a project from the beginning?
I'm going to Nick. Yes.
Yes, and that's probably my comment of locking myself in a room, right? Yeah, well, I think it starts with the accountant, because I think it starts with the person who has to interpret and apply and perhaps convince the next person up the chain to say, all right, so this isn't just a new book for us to read, and it isn't just new subtotals for our company. And I'm speaking in the global sense. for our company, it's not just me taking a trial balance and changing it. We do need to bring our FP&A and our budgeting team along. We do need to bring our systems team along. We do need to bring a master data team along, and it probably depends on how the standard is being applied to a particular company and the complexity of that company, and how many kind of touch points there are in that company that all integrate with those financial statements, as to how many people you lock in the dark room on the project team and how long that might take. I guess that'll be my take. It starts with one place, but it may permeate for sure, and it brings home why we start early, because we don't know until we know.
And I think I'll just add to that, there will be flow-on impacts if you have changes, right? Like, I think if you think about debt covenants, right, and how are they measured, has that number changed? Is there something you need to think about? So, you might need Treasury involved so that they're aware of these changes. Your share-based payment arrangements, right, they may have conditions based on EBITDA or a number that is now different. There will be those sorts of flow-on impacts as well that you'll need to also think about. So having employee relations in the room, or whoever it might be, HR, that are drafting these things, you will need to think about the broader business as well. Yeah.
There we go. Alex, we've got a few more questions. Alex and David, I'll give you guys an opportunity, and then, okay, we'll do that. Then I'm wrapping it up.
I guess the vibe or the feeling that I'm getting from Nick and some of the other preparers that I'm engaging is that majority approach to IFRS 18 implementation is incremental. So we'll look at what we do now and sort of see if we need to change something. Andreas, maybe you are aware of examples of entities just starting blank slate. It's like, okay, so now we need to report our performance. How do we do that now that we have a new standard to look into that?
Probably highlighting the concept that Laura said earlier, the aggregation and disaggregation rules in IFRS 18, and highlighting the fact that this is giving us an opportunity. Every other standard has added additional disclosures. This is probably the first time that a standard has come out to say, actually, stop, pause and reflect, and go and look at what you have in totality. Look at materiality, look at your users, understand what the disclosures are, and then go and think about what is in your note disclosures. Think about what is on your P&L. Sorry.
It's all right.
Here we go.
Keep going. So, I agree with Michelle. I think it's probably not such a landmark change that many people saw in that, and that I think came through. Yes, there may be the isolated events where actually this is happening. The core case that has come to our attention, where actually it was more a fundamental change, was when one company acquired another company, and they were sitting on different systems, and they had to converge. And then the question is, of course, which system we make the master system, which one fits into which? Are we just using that to actually get a complete new system? And then obviously, if you do have that opportunity, then you can start making these assumptions. Now, I would also say that in the development of the standard, the board wrote back on a number of proposals that would have been quite burdensome and quite costly. So the most important change that we made to the exposure draft was actually the requirement to be able to flip a presentation by function into a presentation by nature. And the reason why the board did that is because we heard from a majority of preparers, we can't do that. We can't just push a button and it would flip the display of the income statement. So then the board at that time was caught between a rock and a hard place, because the users said, if you're displaying by function, which quite a number of entities are doing, you sit on a big block of cost of sales that's not properly disaggregated. And that gives us a headache because we can't really run our analyses. This is why we want a by nature display. So when we then locked the preparers and the users in one room and said, you fight this out between yourselves, I think there was a very good discussion, because the preparers ask the users, why do you need that information and what do you need that information for? And when the users were clear that they weren't really interested in the entire layout by nature, but they were interested in a few select line items, the preparer said, well, how about if we just give you that number? Would that help you do your investment analysis? Because that would save us an awful lot of time and money, because it would just mean we hardwire certain requirements. Yes, this comes with system changes, but it doesn't change our entire general ledger system, right? So, and in that sense, we've taken, I would say, a huge cost out of the system and out of our requirements. But as I said before, I think probably the one-off business-driven decisions, if you merge with another company or if you have big acquisition and they are sitting on different systems, this is probably the most prominent example where you do a probably more fundamental rethink and reshift. Anyone?
Here we go. David, you had one more question?
No, same. I was going to talk about the opportunity.
Opportunity. There we go. So great ending to this panel discussion. I'm going to just give you a round of applause if you guys can. Thank you very much for very insightful comments and helpful discussion today. The last piece of today is the panel that's aren't completely done yet. We're going to just have a few table discussions. There's two questions essentially that we're going to cover off. The first one is around there we go. The impact of the new requirements on financial statements. So just having a table group discussion about what do you consider the round table what do you consider the financial statements impact to be and what challenges they might be, as well as opportunities. Am I missing something? Okay, that's fine. There are some prompting questions on your tables, or there should be. Yes? Do you have it? Yes? Okay, there we go. We will cut this session a little bit shorter than anticipated, so we'll give you 5 minutes for this conversation. Highlights, people. But let's share some interesting thoughts here. I guess sharing information is probably the best way for us to start getting our heads around what IFRS 18 is going to do for ourselves. It helps us brainstorm what is working for others, where challenges might be, and learnings from others helps us also develop our own skill set. So I'm going to encourage these types of conversations, and that's the way that we do away with some of the cost in the system for ourselves, is sharing knowledge and communities coming together and really just helping each other in terms of learning and their pathways. I guess I'm going to look to the audience, everybody here. Is there anyone that wanted to say or mention something that's come out of the table conversation that we haven't covered today that you thought, wow, that's a really useful comment? There we go.
One thing that kind of came up is that obviously people here are engaged, everything else, but there's also a lot of other people who have to report, have to go through auditors that are not so engaged in the processes yet, and will get to the point of having to prepare their first set, and all of a sudden this stuff will come out, including dealing with management and everything else, auditors, fees, you name it. Has any communications kind of come out just to highlight that, that it's not just a simple just reorganise and do that?
I might take this one from the XRB. I'm going to say we've done a lot. We really have. We have really, our team, I'm going to look to Carly specifically, and big shout out to her and Nimesh. I don't know where he is at the moment. Are they also there? But that's our IFRS 18 team. They're amazing. We've done a lot of educational materials, webinars on the website that you can access. We have IFRS 18 on the 18th that we ran last year. This year we put out quarterly alerts, just keeping you up to date about those IFRS agenda decisions, etc. So yes, the uptake of that has been from our end quite significantly more than what we've seen in the past. We have a lot of people subscribing to our channels, etc., and we do try and make it a point of mentioning this everywhere that we go. So that's what we're doing. We have a role to play. Big Six, all audit firms have a role to play. CANS has a role to play. And then I'm sorry to say, but the preparers also have a role to play. You probably need to know what you're doing. If you are in the finance structure, you need to know there's changes coming up, staying abreast of those changes, etc. So we're trying everything that we can. Happy to hear what else we need to do.
I was just going to say, has anyone actually got MB to send something out for companies filing? Because that would
Yes.
be really useful.
That's useful. We do speak to MB quite regularly on a lot of activity. I must be honest, most recently in corporate societies has taken quite a bit of headspace there. But that doesn't take away, we will have another conversation with MB. Did anyone on the panel wanted to add that? Okay, cool. Got that. Anyone else? Any other final thoughts? Okay. The last question, I won't necessarily have you guys talk about it because I think you've met each other now. I guess the main question here is, how are you thinking about implementation, system and communications? And we have covered it quite a lot in the morning conversation, but really the point that we were trying to make is make sure that you understand it's not just limited to your financial statements. Make sure that you understand there's communication that needs to happen throughout your organization. You actually need to know how your investor team is going out and talking about your performance, because that is an MPM. It's publicly communicated. How are they communicating that, etc. I guess the other piece that I wanted to highlight is on MPMs, we have touched on it, but I really want to highlight this. It's now in your financial statements. It now needs to get audited. So make sure that you do have the right level of audit evidence required for that. It does change the way that you go about your preparation of documentation, or could change the way. And then the last thing is make sure that you have enough headroom for yourself to create space to, if you do find challenges that you need to work through, you've got time to address those. I cannot emphasize that enough. That is my final few words. I'm going to hand over to each of our panelists just for a final wrap up. I'll start with Nick because I was directed that way.
Great. Eager. I guess my final word would be similar to my starting word, if I can bookend what I've had to say. I came into the journey, intimidated and going, oh no, what am I going to have to do here? And what does this impact? And what does it change? And here goes another year of my life trying to implement a standard. But once I started slowly walking through it, it actually wasn't as daunting as I initially thought it was. We don't need to panic. We don't need to throw our toys out of the cot and say, no, it's too hard, I can't do it, I'm going to put my head deep into the sand and worry about it when my auditors tell me to. It was just a matter of getting over that initial hurdle of, all right, here we go, and then slowly walking through the process. And I can't say it's going to be easy for everyone because every company's different and every outcome's going to be different, but at least that beginning part of the journey shouldn't be too bad to make a start, to go into that dark room and make a start.
Laura.
I guess my key message would be, you can do this now. You don't need to wait till year end when you're trying to prepare your accounts and you're trying to get it out there. It can be done now. You can draft your policies, you can think about things and make a start. And like Susan says, maybe come and see your advisors and we can help you draft accounting policies and establish where you might want to go. I think just don't leave it till the last minute would be my key message, which we haven't really said today, but that's almost obvious, I suppose. Mm-hmm. Yeah.
My message would be really falling in line, but probably be a bit more aggressive. I hope that all of you have started, right? Because sometimes the bloody surprise is actually, oh, do we have to do comparatives? Right, because if you find out that there is a piece of data that actually should have gone into the comparators, but you don't have the machine to spit that out, tough luck, right? This is a difficult thing. So obviously we always think there's nothing more important than accounting, and as soon as we publish, we hope that you all read the standard from front to end and get started. We know that's not how the word actually ticks, and that's perfectly fine. But I would re-emphasize some of the messages that we heard that I think both of you gave. I thought your question was excellent. Actually, don't just leave this to the accountants, right? Accounting is part of the business. And I think if there's one message that I would really bring out is accountants have to become more business-minded people, and they have to think about, okay, who else in my organization may be impacted by that. It's probably a bit more difficult if you do have a standard that just deals with presentation and disclosure. It becomes pretty obvious if measurement is involved, right? And we had big examples like IFRS 17 on insurance contracts, where one of the big learnings that we got back is we don't like that standard, but gee, what I learned as an accountant is how much expertise we actually have in-house, right? By looking into the treasury people, by looking into the actuarial functions. And I think that is probably the kind of discussion that needs to happen on an ongoing basis, right? And if you really look at this from that point, I think you will always have a high quality implementation.
There we go. Thank you very much for everybody's participation today. That does bring us to a close, and we do have, well, I'm 10 minutes over. You did think it was going to be more. We're 10 minutes over, but we did book it until 12. There is some networking happening now, so do stay around, speak to each other, share some ideas. I'm hoping that these conversations will happen more often. And thank you very much for taking time out of your day. We really appreciated it. Thank you. Carolyn, she'll end off with a karakia.
I will, and I wanted to echo Michelle's thanks. And when I think about the IASB, you haven't just written the standard, because Andreas was with us 2.5 years ago and introduced 18. It was still, I think, being developed at that point. And then we had the deputy chair of the IASB, Linda Metson-Haka, come out 18 months ago, and now we have Andreas again. So although we're a small country at the bottom of the world, we do appreciate you coming all those thousands of kilometres. And thank you, Lara, thank you, Nick, and thank you to the discussions and the tables. It's been fantastic. So as we go out into another busy day at the office and things overwhelm us, just a blessing and a wish. Kia hora ti marino, kia whakapapa pounamu tu moana, hei huarahi mā tātou e te rangi, aroha atu, aroha mai, tātou e tātou katoa, humie, huie, taiki e. Thank you.